Welcome back, everyone. And if this is your first time clicking on this, well, just plain welcome. Today we are buying a stock. In fact, we're buying two. This is our monthly stock purchase, month 31. And we are going to go over our portfolio and tell you exactly what we bought.
In case you're wondering why this is so raw, we did a video, I think it was month 30 or 29, where we asked people, hey, this is unscripted. Do you want to see this scripted or unscripted? And I'm not sure if the people were just being facetious, like, we want to see Tom unscripted. Are you kidding me? But they said they wanted to see us unscripted. So this is unscripted. We have bullet points. We have them up here for you to see. And that's all we have. So we're going to go through the portfolio. We're going to talk about what we purchased. And we have no idea what we're going to say while we do it. So hang on for the ride.
We asked you, you told us, and if you wanted to see it scripted and you didn't say anything, well, this is on you.
Yeah, for goodness sakes. If you see me talking for like 15 minutes about bonds and interest rates.
I'll stop him before that.
Yeah, just tell us you liked them scripted and we'll do that next. So that's how we got to this point. We've been investing for 31 months. And if you're looking at the title wondering, we're going to get into the portfolio. You're going to see what our income is. So you have a pretty good idea of what to expect. Now, this portfolio is, 2.5 years old now. And this was assuming the average household income at the time only had $400 a month left over in disposable income. So from that, we used that to start a brand new portfolio. And that got us to the point where we're at today. So if you did the same thing, this is about what you would expect 2 years from now. There's a couple caveats there. The recession, the election, World War III. There's a whole bunch of things that could happen. We have a stock market that is it's a huge bubble.
It is a huge bubble.
Like it's just gonna pop someday. We don't know which day.
Maybe after the election. We'll see.
We'll see.
Now, here's the thing. If you've been watching us from the beginning, or if you go back and see our playlist, we'll put it up here, of all of our stock picks, we put our portfolio out there for all to see at the time. So you could see it grow over time. And you'll notice that at some point, we go from the $400 a month to $1,000 a month or $2,000 a month. And that's really to indicate, growth as far as salaries and such, and to, help grow the portfolio.
There's another reason too, is there's what people don't see about YouTube. If we're talking the problems with YouTube, Brian and I are IT guys. We do well in finance. We've done well investing. This whole YouTube universe is a different world to us. Now, there's a few problems with it. If you look at YouTube, you go to the homepage and there's hundreds of thumbnails. And if you find our thumbnail, we're like the bottom corner of the building with some cobwebs on it. Our titles and our thumbnails aren't as catchy as some of these other YouTube channels that are out there, and we're just not as clickbaity.
Well, we want to be authentic. That's the problem. We try to make it as authentic to the video as possible so that you look at the thumbnail, you know what the video is about. So, other people will put all kinds of very sensational things in their thumbnails and their titles to make you click on it. But they are ones that don't show you their entire portfolio. They just show you the winners. They don't show you the losers. And we'll show you the winners and losers. You could track it over time.
Yep. Now, in those videos where they do the portfolio reveals, you'll see, I'm going to reveal my portfolio. And you're like, oh, great, I'm going to see it. And then it's this Excel spreadsheet where it's not actually the purchase that they made. It's just what their value is. And they hide it one line at a time, where you just get revealed one at a line. Right. And that way, if they make a bad investment decision or they screw it up, they don't have to include that in their decisions.
Exactly.
And YouTube it's a lot of work. A lot of people don't realize that there's a lot that goes into it, and we're not paid from YouTube. So the fact that this is raw and it is the way it is just because, hey, look, we wanted to help people achieve what we have done over the course of a long period of time. You're not going to get into this channel and do investing the way we've done it and get rich overnight. This is not one of those channels.
Right, and we do it part-time, so it takes a lot of work just to put out one video. So that's why you usually only get once a week.
Right. With YouTube finance, we've railed against this for a while. There's a lot of get rich quick. There's a lot of gambling. There's a lot of people out there who will be promoting a business, and you as the viewer won't really understand what's actually happening there. Is sometimes a company will come to a influencer and say, hey, we will pay you to promote this crypto, to promote this stock so that they can get equity to build their business. Now, as a viewer, you think that they might, and gosh, they sound so convincing. These people, they're energetic, they're all into it, and you're thinking, oh, well, this must be a good buy. But then, the company goes down 60% or 90% after they buy it. What they're not telling you is they're getting paid to promote that business so the business can, use that equity to do something. Like they can take that cash and spend it on a new fleet of vehicles or buy a new yacht.
Usually it's the yacht.
Or something. So one thing we want to cover before we get into the portfolio is in the stock market, you're buying a piece of that business and you want to share in the profit that the service or product that business produces. So if you're going to sell a stock, somebody thinks it's worth more than you do, and you have to sell it to somebody.
Right.
If you're going to buy a stock, then somebody has to be willing to sell it to you. So you have to question why they would be willing to sell it to you, or why would you be willing to buy it from them. And that's true of any stock that you would basically buy, not except for like bonds and stuff. But
we're not going to go there.
No, that's a different discussion. But that's when you buy a company, that's what's basically happening. So in our portfolio, we try to make sure that we're buying companies that have products and services that people kind of have to have. It protects us against all of this.
Right. And those are the questions we try to ask when we look at stocks.
Yep. In this portfolio, you're not going to see a whole lot of exciting stuff in there, but you should notice a trend. If you go back to the first month, well, maybe if you bear with us on month 2, good on you. But if you go back to month 2 all the way to today, you're going to notice a trend in what happens. And in particular, if you look at our portfolio here, we'll pull it up on the screen so you can see that part of it. We have it sorted here by the gain and loss of the stock itself. So we've got about 56,000-ish in the portfolio, and that basically is all the stocks, but like one of them pay us a dividend. The one that's most profitable is 3M. And 3M at the time when we bought them, we got trolled by it from people that we knew. It was like, why are you buying them? They're in trouble. There's a lawsuit. There's all this stuff happening.
They were in trouble. They were down. And that's what we like. We like a beat up stock, but of a good company that's going to give us money over time.
And we said it when we bought them. It's just like what we're saying about Intel right now. These businesses are relatively safe in the long run, but in the short term, a lot of the companies that we were buying were controversial.
Right. And now it's up 62% from the time we bought it.
Yep.
Now, just because we like disclosure, if you go to Devon's down 15% from when we bought it. But if you go and look at the gain loss, there's a lot more green than there is red.
Yeah, and today's a down day. We're like $500 down today, which is, a good buying opportunity, I guess, if you think about the market as it's going on sale. But we've got a few stocks in our portfolio. So if you look, there's 22 positions, I believe, in this particular portfolio. And of all of those stocks, we would personally only say that maybe 3 or 4 of them are risky. And we've talked about it. We bought those in Alley Capitals when we said, hey, these guys are very heavily diluting their shares. That's a risky play. But their dividend is huge. They're an REIT. Right. REITs function a little differently. The other ones that we felt were kind of risky were RAL, Rio Tinto, because they were directly tied to basically the materials business, mining in general. And then we also had Devon Energy. Now, Devon Energy is very cyclical. They're kind of like Zim. They cycle in and out based on what the market's doing.
Right.
And we said that going into that, hey, look, these are riskier plays. The reason why we bought those and we buy only like 10 or 12% of our portfolio weighted on those is so we can show people this is what happens when you buy the risky plays. And the other problem is when the market crashes, those are the ones that get hit the hardest.
Right.
Those get destroyed.
But the other point that we were trying to make was that once you get your portfolio pretty equal, you can get into those riskier plays. And it's okay because you have a foundation of stocks that's going to pay you over time, that's going to give you money to pay for those stocks.
Yeah, and what we're trying to say too with this is if you're jumping in on month 31, don't just go back and buy an equal weighting of shares of all the businesses we have. Watch those videos because it helps us out. But also know that the opportunities that existed for 3M at the time aren't the same opportunities today.
Right.
So would we buy 3M today? Well, we'd have to look at them again. It's different today than it was when they were getting all beat up. So we tend to look for businesses that are just getting brutalized. There's a lot of negative sentiment, which means we're going against the grain. There's a contrarian mindset to that. And that's it's sometimes hard to do that because you get trolled a lot. Like we're getting trolled for Intel, like, oh, they're getting destroyed. Why would you buy Intel? It's like, yeah, you get that when you buy stocks that are beat up. But you also have to understand that you got to look at the business. You have to look at the finances for the business, look at their customer base, look at their product, look at what they're doing to get past those problems. And that's not an easy investment strategy. But if you look at the portfolio in itself, all you're seeing is just the stocks themselves. This is not including the income. So if you look at our income and you go out over the next 12 months, you're going to see that we're almost, what is that, like 172?
Yeah.
Yeah, so if you look at that and you're excluding Intel from that picture, we are getting $2,068 in the next year in just passive income. The market can crash. Even if it was the typical 40% crash, it could crash that much. We're still going to get that income because we know these companies are producing products that are going to pay us. I would rather make a very small percentage on a nut or a bolt or something that like Fastenal sells, knowing that that's a product that gets used out in the market, than try to make a big play on some kind of speculative investment. Unfortunately for all you fanboys, like Nvidia. Nvidia is very heavily overweight, we believe, but that's also, and yeah, they do produce a product. You say, well, they got this AI and they got the video cards. Yes, they do, but they're very expensive products. I would rather make a small percentage on an affordable product than try to go big or go home on something that's not necessarily a good play long term. Why? Because the stock market does actually crash. We've been through a few of them. We've seen it. Now, anybody who's been investing for 10 years or less, you haven't seen it.
Right.
Like you haven't been through a crash. And usually when it crashes, it's about 40%. So if you're looking at this portfolio, if it was this portfolio, we'd be down to 30 grand if it crashed like that. However, the dividend income, the last two crashes I've been through, the dividend income went up.
Right.
Like I made more money. AT&T is a really good example. They paid 40 cents per share, and then as the market was crashing 2008, 2009, they went up to like $1.20 and then $2.10 for this per share. Because everybody was bailing out, they already declared their dividend. There's less people that held the stock, so here you go.
More distribution for us.
Now, it doesn't always, like, not every company does that.
Right.
But in this case, we are holding on to these stocks a very long time. And that dividend income that comes in it's not just the income that you get this year, it's what happens over a long period of time.
And that's $2,000 on $56,000 invested. Now think if that's $560,000 invested.
Yep. That's a mortgage payment.
Yep.
Or some pretty fancy cars. You can get a pretty fancy car for $2,000 a month almost.
You can.
That's a nice car.
So what this really goes into is the dividend growth that we have is what, around 9-12%, depending on?
Yeah, dividends. So if your company is a business that produces products that people have to have, natural inflation from what the Fed does, that's a whole different conversation in itself, especially when you're dealing with like global countries and the Federal Reserve and the central banks. We're not going to get into that. The bottom line of that is essentially because of inflation, if your Starbucks coffee costs $3 this year, and everybody knows the story of really well lately, next year it might be $3.30. And the year after that, it might be $3.45. So the natural inclination is for these prices to go up. That doesn't just affect the stock price, that affects their dividend.
Right.
So historically, you can go back, there's some good books on this too, but you can see that your dividend checks will grow by between 9 and 12% per year, assuming the business is healthy. One of our stocks in our portfolio, Intel, cut their dividend because they are not doing healthy. So you have to be very cognizant of what you're buying that way. But if you were getting, $100 a month this year, assuming the businesses are healthy, you're going to get maybe $110 next year.
Which brings us into an important term that you should know is compounding interest, or the snowball effect.
Yep.
And we generally will not look at the short term and look at the long term over our lifetime of investing, and that's where you're really getting the growth.
Yep. Brian and I have done very well investing. Now, this took 20 years for me. Brian's a little bit longer than that. but we made a lot of money over a long period of time doing this. So if you're thinking you're going to jump in and say, I'm going to buy all this stock, it's going to go up 10,000%, I'm going to quit my job. No, let's keep your job, do well at your job, keep doing what you're doing over a long period of time. Let's say we took this portfolio right here that we have, $172 a month. What is that, like a cell phone payment?
Yeah.
Sure, you're paying your cell phone bill with that. Okay, let's take it out 2 more years. So now we're about $350 plus the 10% growth. So you get about $375, maybe $400 a month. Now we're gonna post that on this channel so you can watch it happen. But 4 years into it, you got about $400 a month. What is that? That's your cell phone bill, that's the electric bill, that's your heat bill, that's your trash bill. As this keeps building and time goes on, after about 10, 12 years, you're $1,000, $1,500 a month. So that's really good. You can buy stuff for that. You can buy a lot of stuff for that. It's not quitting your job, but if you ever have a problem with your job, or if you get laid off, or if you need money in a pinch, your car breaks down, or let's say you thought you were going to get some money from something or to pay off a debt or something, now you're not going to get it. This is a really good way to protect yourself from that. And over 20 years, you'll make millions.
Right. And we're not advocating that you spend that dividend every month on something. If you have a job and you could pay your bills with your job, roll that in, reinvest those dividends and grow it faster.
Brian keeps harping on me because I keep buying stuff with my dividends.
He does. I pretty much reinvested all my dividends over my lifetime because, I've had a good job that I could pay my bills with and get the things that I generally need or want. So it does grow faster if you reinvest those dividends.
Yeah, and we're not talking like $50 here and there. I'm buying like pianos, Porsches, BMWs, like projectors.
like $20,000 here, $20,000 there. So
yeah, so
imagine where you'd be if you just if you had reinvested all that, kept it going.
Probably wouldn't be taking so many help desk calls. But the point is that it actually works.
It does.
We're living, breathing proof, and all of the sea of YouTube clickbait crap that's out there, the reason why we're unscripted is at least because we want you to see we're being authentic. That's why the portfolio is shown in all its raw glory. So if we really F it up and there's like a really bad stock play, you're gonna see that. That's just the way it is. So the other part of this too is because we have jobs, I run a company, and because it's really hard to track a lot of companies all at the same time and do well with that, our monthly purchase this month is more of the same. And you're gonna see that over and over and over again, because if you know what's happening with the business, you know when they go on sale and you know when there's a good opportunity. And right now, based on all, like you can check, we did a video on these stocks, the stocks we bought this month, UPS and Intel. You can go back and look at those videos. We feel that UPS is on sale. We feel that Intel is on sale. Now, Intel's a little bit of a risk because TSMC and Qualcomm and all the others are, they're getting a little greedy. I think one of them wants to buy Intel. But we feel that the United States government needs to have a business that's sourced locally for a lot of these chips that we've used for our military and for the automotive sector and everything else going on there. So we feel that Intel right now is a pretty good buy. So this month, we bought UPS and Intel again.
Yes, we already have it, something that we know. And honestly, when you go through all the screeners and look at all the other stocks that are out there, there isn't anything that is beat up on fire that is a good company that we want to invest in.
It's hard it's hard to find those opportunities. So when you do, you tend to jump in, and you jump in a lot.
Right.
And I know there's trolls out there like, oh, you're buying these stocks, you should buy this one, it's going to pay you more money. It's like, no, it's not like that. You don't make money that way.
Right. It's very risky. You could lose money too, quite easily.
Very easily. Yeah. There's a guy in my neighborhood. He trades stocks and he shorts and he does futures. So he does calls and puts and stuff after hours, and he can see that. And I says, so hey, what if I shorted Nvidia stock? Like, tech stocks trade 15 times earnings. This is a 1.5 to 1.8 trillion company. Right now it's at 3.4 trillion. I says, what if I just did like 100 million? And I pulled it all up, and there was that option to do it. It was right there. It's like, should I do it? And I couldn't do it. And he goes, it's a good thing you didn't. And I says, what do you mean? He goes, well, I do this professionally, and I'm one of the few people, like the IRS says 1% of the people actually make money doing this. So he's one of the guys that did it. And he goes, when the people see that, these options and day traders and all the people that do this professionally see that, they're going to see this huge order go through, and they're just going to make you wait on it. They're gonna capitalize on that, and they can probably outlast you with their not only their money but their patience.
Right.
So there's a crowd of people out there. He says if you are, maybe we can get him on the channel at some point, but he said the people that are most likely to make money in the stock market are people who just sit on the stocks for a long period of time. And it's not just for the capital appreciation of the stock. It's for taxes, fees. It's for, like, if you sell a stock and you own it for less than a year, you don't just pay capital gains taxes on that, you pay income taxes. So sure, you buy a stock, it goes up 10% like Fastenal did was it 2 weeks ago?
Right.
Yeah, so it goes up 10% a couple of weeks ago, and you're thinking, oh, I made all this money. Sure, it goes up 10%, but then if you held it for less than a year, you're paying income taxes on it, which is more than 10%. So did you really make money?
No, you have to make a lot of money on the sale of a stock to actually make money on it.
Right. So there's a reason why we do this, and it's not just for taxes or income. It's the method to the madness is that the long-term play on this, if it's a good business, you will make a lot of money.
Right. Because of compounding interest. Over time, it's going to keep doubling, and your original $400 will become $2 million in 30 years.
Not quite 30. It was what, 20, 25, 24, something like that?
24 years.
Yeah, I think I've been doing this for about 24 years. So that strategy that we do also eliminates risk. And the more you get into this, the more you'll see how predictive the market can be of what they think is going to happen and how much money they can throw at it, even if there's nothing to justify it.
Like Fastenal.
Or Nvidia.
Or Nvidia,
any of the meme stocks that are out there. I'm saying it right now. I used to say Mimi. But that whole, like, economy is just different. And if you're trying to build a passive income portfolio that pays you a long period of time, you need to think about this long term. And I know we're beating that horse like crazy, but it's true. There's a lot of people who will buy stock and they'll lose money because it drops and think, oh my God, I need to sell today.
Yeah, don't do that. Think of the long term. The second reason why we bought UPS and Intel is because we'd like to keep under 30 stocks. Because I don't know if you've done stock research, it takes a long time to do stock research. And if you got 100 stocks to go through, you're just going to get through your 100 stocks and you have to start over because it's a new week. So it's like, it takes a long time. And we try to keep a manageable amount that we could keep track of.
Now we have a Teams chat, so we use Microsoft software, and there's a thing in there called Tom's Rant Therapy. It was like Tom's Stock originally is what started to Tom's Stock Research, but eventually it devolved into like this rage thing, nerd rage thing, because I will read article after article after article after article and just research what's happening in the market globally, United States, with all these businesses and things that politically are happening or things that happen in the news that relate to these businesses, because things that happen in the world influence businesses, obviously. But there's so much there that you just can't keep up with it, at least not easily. We try to keep it to a minimum amount of businesses that we understand and basically that we can keep up with. That does create a bit of a kind of a boring thing, like, oh God, you're buying the same companies that you bought and you're buying the same 2 months in a row now. Ooh.
Well, it's not exactly dollar cost averaging into it, but it's the same kind of idea.
Yeah, but look at 3M, look at Fastenal, look at the other companies in our portfolio. Understand why we do that by just looking at the numbers go up.
Right.
We could sell 3M. We've had it for, have we had it for a year? About a year now.
We've had it for a year.
Yeah, so we could sell that and we wouldn't pay income taxes on it now. So I could take my 60% and go buy something else. The problem is, in this portfolio, I can't buy a projector. I have to buy another stock. So what would I buy if I sold 3M today? Now, if you've got companies you want us to look at, you think would be great, we could sell 3M, but we have to have something else to buy that also pays a dividend. I know that's a roundabout way of explaining why we keep buying the same things, but it's hard to track more than just a few opportunities and track them well.
Right, and if you're gonna have 100 or 150 stocks in your portfolio, you might as well just find a good index fund that has those stocks in it and just pay into that.
Yeah, I mean, there's ETFs out there too, like JEPI and SCHD that basically do the same thing. They've got 100, I think SCHD and JEPI have almost 100 stocks in them, don't they?
Yeah. Maybe someday we'll just start an index fund or ETF and of our own.
Bloomberg, Morningstar, if you guys are watching, we'd like to do that.
Yeah.
We'd like to have, like, hey, follow along, just buy the symbol. It's a lot easier than just having them try to figure out what's in our list and just make one.
And buy it when we buy it. That's hard to do.
And we've got proof in the pudding. I mean, you can look at the index funds, you can look at what we did, and we're matching, if not beating, most of the index funds. Next opportunities. We have an election to get through. A little worried about it. Doesn't matter which party wins. I'm still worried about it. For my part, people need to stop fighting.
Exactly. And normally we wouldn't buy a stock at all, except we have this stupid thing that we started when we started the channel, is that we have to buy a stock every month so that we have something to show you that you should buy. But if you're going to have, if you have money that you're going to buy the stocks like we have, I would just hang on to it until after the election and see what happens.
Yep. There's another point to this. We talked about UPS and Intel. I'm not sure that, like, if you're watching this, you're saying, well, you didn't really explain it good enough. He says, we did 2 videos on UPS and Intel. You can watch those, but please understand too, they're depressed relative to the size of the business. Intel is trading pretty close to their book value. UPS, even though they're heavily unionized, they're also getting beat up unnecessarily based on the COVID bubble getting popped. There's more to it than that, and there's a lot more to, but this is just us, what we actually decided after going through all the research. So there's a lot more that goes into it. If you want us to get into the numbers more, just comment below. We'll get into that. We'll explain it a little bit better to you.
I'll put the videos up here and go watch them next, and then come back and comment here if there's something that you'd rather know about that we didn't cover. On that note, we tend to talk about just stocks in this video. We started off the channel talking about terms and simple things that you should know, and we stopped doing that. So lately it's just been stocks and ETFs and stuff like that. If there's something that you guys want to know about that's not just a stock, let us know. Put it in the comments, and we could do a video on that.
Yep. Also, if you feel there's a stock that would be a good opportunity for us to look at, we'll look at that too. We do get them from time to time. Most of the time, like if people suggest a particular company, there was American States Water Corporation. We actually added that to our portfolio, but they were one of like 12 that people recommended. So I imagine as the channel grows, it's going to become harder for us to look at the individual ones that people get us, but we do actually pay attention to it, and we do look at them. Now, if you suggested a stock to us and we looked at it and it feels like you're being ignored, tell us, and we'll explain why that didn't come up in one of our portfolio purchases or why we haven't done a video on it yet. Because there's probably a pretty good reason. Like, there's a red flag that came up to us almost immediately. Like, yeah, these guys aren't making any money, and this is why. So we can certainly tell you that, but there's, like I said, YouTube is part-time for us. YouTube does not pay us. That's something else I want to highlight. We're not getting paid for this. We have 5,000 subs, but the watch time is not there yet. So this portfolio...
Watch more, people.
Put it on repeat. That'll not make you go crazy.
Maybe we should have like a Patreon or Kajibi type thing that has forums in there, and there's a spot where they could just put stocks and we could talk about it.
Yeah, we'll figure that out. I mean, the whole point was...
Would you like that? Would that work for you guys?
Yeah, the whole point of this is to bring value to you. So if that's what you think brings you value, if that helps you get to retirement, because like I was telling Brian this before we recorded, that it's easy for me to take Tom's Nerd Rage chat and do all this research of stocks, and then in my own little perfect legendary mind, I'm like, oh, I'll buy that one. And people are like, why'd you buy that one? And there's hours of research, but then to try to get all of that into a video format that's less than 30 minutes is really hard, actually.
Exactly. And this is probably, what is this? This is 29 minutes. So we got 15 seconds to wrap this up for 30 minutes.
Bingo. So there's a lot that goes into this stuff that it's just easier for us to do this individually. So this whole portfolio and everything here is for you.
Yep.
So if you need some advice, you need some other help on some of this, tell us. We will help you where we can. And hopefully long term that you'll get either similar results or hopefully better than what we're getting in the very portfolio, because we don't have to do this. We just got tired of all the trolls and just the gambling that we see on YouTube. That's just not cool. There's a better way.
There is.
There's a better way.
Yep.
So with that, I think that's it for me.
That is. Keep watching, like, subscribe, do all the YouTube-y things. Help us to get to a point where we can do this full time. and get more videos out to you.
Well, he'll do it full time. I'm an IT nerd. I run an IT company. I'll be doing that for probably the rest of my life.
Yeah, you're chained. Chained to your desk.
It's like a marriage.
It is, until you sell it.
Except my marriage is fun. There's a difference. All right, guys, thanks for watching. If you got all the way to the end, thank you very much, and hope to see you in the next video. Peace out.
Peace.